Let's end with your picks for the best new exchange-traded funds of 2019. Tom, you're looking at communication services. Now, this was essentially rolled up from last year in the changes that were made.
So GICS had a new sector naming issue going on where they removed telecommunications sector, made it the communication sector. If you look at the lineup, it's stuffed full with cap-weighted FANG stocks, but it's got over $4 billion in it. The expense ratio is 13 basis points. As you know, we're going to go on stage tomorrow and battle it out as far as the best new ETF. It's innovative when you go back and look how many times has S&P actually changed sectors. Not that often. This is the sector of the future. Out of all cap-weighted sectors, it's number 2 compared to financial services.
Alphabet, 23% of the weighting. Facebook, 19%. Two companies are 42% of the weighting. This is what we constantly warn people about, market cap weighting. And when you get those kinds of companies, it distorts the whole picture.
It's the majority of the way people invest today. And State Street and GICS identified that. They've taken advantage of it. It is innovative because it's modern technology today, packaged in a very simple form, very, very cheaply, and it brought in more money than any other new ETF last year.
Rick, I don't have to wonder about what's going on with you. XT, you were one of the original. Is it fair to say you practically helped invent the concept of exponential finance investing, or am I giving it too much credit?
No, I did. I invented the category. I went to BlackRock and asked them to create an iShares ETF based on exponential technologies, which they agreed to do. We were the early funders of it at Edelman Financial Engines. We've increased our allocation to it over the years. We're very pleased with it, and that has created a new space in the exponential technologies field. So you've got the Kensho funds at State Street, you've got ARK Investments and a variety of others, probably a dozen or two funds in this space now, which is fabulous for the investor.
It's a big fund. It's got 200 companies in it. And
yes, and it's equally weighted for exactly the reason you cited, because we didn't want disproportionate investment.
But so the top holdings, you get equally weighted. Lam Research, Xilinx, Celgene, Takeda Pharmaceuticals. So it's not a single industry. It's across many industries.
It's across the broad spectrum of exponential technologies, including globally, large cap as well as small cap.
And a small outperformer over the last couple of years compared to the last.
Yes, it's performing fine, and on a risk-adjusted basis, even better so.
I got to ask you about the Bitcoin ETFs. I know you're a major proponent of Bitcoin. You have this wonderful argument about 1% of your money in Bitcoin, but the fact is there's no Bitcoin ETF. Bitcoin has suffered from the lack of a Bitcoin ETF. Trading is way down. We've got several that are in registration with the SEC, but they've made it very clear what their concerns are. Handicap this. What's the chances of seeing a Bitcoin ETF?
It's virtually certain. The only question is when, and I don't know how soon it'll happen. The SEC has several legitimate, thoughtful concerns that the industry has to overcome, but I'm confident that they will. And eventually we will see a Bitcoin ETF, and it's at that stage that I will be much more comfortable recommending that ordinary investors participate.
And how, again, the SEC's principal concern, there's two of them. Number one is custody.
Yes.
You have to show us that you have a secure chain of custody, just like the stock market does and everybody else. And number two, overseas trading, where most of the prices are set on platforms that we don't control at all. These are not easy things to overcome.
True, but we've got some serious players. Fidelity has made a major announcement in the custody issue. We've got Kingdom Trust and a number of other very serious players on the custody side. I'm confident that in very short order, Van Eck or Bitwise will satisfy the custody concern of the SEC. Manipulation is another one. I put Bitcoin in the same category as oil and gold. Globally traded assets beyond the control of the SEC, and the SEC is just going to have to shrug and say, that's the way it is.
You have a very interesting point about the 1% argument, and we only have a brief period to do this, but explain why 1% is worth it having in your portfolio, given how volatile it is, and people say, no, you can't, it's not appropriate for my investment.
And it's because of the volatility. It works to your advantage. Instead of having volatility of 2 or 3% a day, this thing, typically you can see go up 10 or 20% in a day. We've seen 1,500% in a year. And that ridiculous level of volatility is what makes the bet, if it wins, a huge winner, but if it loses, it's 1% of the portfolio. It's immaterial.
It's really a numbers game. It's actually an interesting argument, and the volatility is the key. So if you get up, 20%, you're all of a sudden now you're up nicely for the day on that investment. But if you're down, it doesn't.
It's an alternative strategy, and the thing is, there's pent-up demand. We interview advisors all the time. 74% say they've talked to clients about their interest in Bitcoin. So they need to step up when this happens, because that money is going to go elsewhere, and you want to make sure you manage that is part of the pool.
One thing we're quite certain is the business overall is going to grow. 3.6 trillion. We've been watching it grow year after year, and I agree with the point that you've made before. Getting the 401k business. Just handicap that for us quickly. How far away are we from getting big money going in?
It could happen tomorrow.
ETFs from the 401k.
Technologically, regulation-wise, it could happen tomorrow. There's no particular motivation because the powers that be in the fund industry have no incentive to give up their market share.
And why bother? Well, that's going to be the next great breakthrough. And you're right. That'll be like the 1980s were for the mutual fund industry.